In conjunction with Nareit's REITweek 2020, which is being held virtually this year, I'm joined today by Michael Knott, Managing Director and Head of U.S. REIT Research with Green Street Advisors. Michael, can you start by telling us about Green Street's view on net operating income growth in a post-COVID-19 world?
So our view is that we're in a deep recession. I think the length is open for debate. The speed of the recovery is open for debate. I think we are of the view this is not a V-shaped recovery, despite some recent optimism in the market. Obviously, the vaccine outlook can change things pretty dramatically, but as of now, we expect that you're not going to achieve a 19 pace of GDP growth until sometime in mid-22. So that's the underlying thinking affecting our view on real estate property sector NOI growth over the next few years. Obviously, there are a number of COVID-specific challenges and issues with specific sectors. So all that's playing into our outlook for what's going to happen to cash flow growth at the property level. So no surprise, we expect the digital economy sectors, so cell towers, data centers, to fare better over the next several years. We think many of these sectors will have higher NOI growth versus 19, manufactured housing, for example. And then conversely, we think that several of the COVID hit sectors will fare noticeably worse. Malls, lodging, net lease, strip centers. We think in those cases, you're going to have NOI over the next few years that's lower than 19 levels. So that's sort of our current outlook. I would say that also really of interest is the change in the forecast. So not only the absolute forecast now, but also what's changed versus pre-COVID. And I would say that, as we look at our economic outlook, we look at 2024 as sort of a more stabilized level. And when we compare 24 cash flow estimates now versus pre-COVID, on average, we're about 7% lower. So that there is some permanent economic damage that we don't recover, and that does leave some scar on property values. It obviously varies tremendously by sector. I think for those challenge sectors that we talked about, the range of 24 cash flow is anywhere from 10 to 20% worse than our pre-COVID forecast. So lodging, maybe 10% below, strips and malls, 15 to 20% below.
And what's Green Street's view on how the public market is pricing risk and return across property sectors?
So it's always important to be respectful, I think, of the market signal. We think it's really important in commercial real estate to be able to talk both public and private and be able to interpret the signals that the public market is sending. I think that's particularly important in this case, in this COVID episode. So with the notable share price declines we've seen on net since late February, if you unlever those and think about share price declines on an enterprise value basis as a proxy for what the market is signaling about changes in property values, that decline on cumulative basis since late February is about 20%. So the market's saying on average, commercial real estate values are down about 20%. Obviously, there's not much of a private market activity to look to at the moment. So the public market is sort of giving its indication of where it thinks values are headed. And that range of down 20% really, again, varies quite a bit from 0% for those digital economy sectors to over 30% for malls, lodging, things that are particularly COVID challenged. So what we can do is compare our revised near-term forecasts and long-term forecasts now in a post-COVID world and really compare that to what the public market is priced in. And I think some of the changes you've seen, some of the signals in the public market really make sense to us and some don't. So lodging is an example where there's been a pretty harsh reaction in the public market. That's one where when we input our new revised forecast, that one makes some sense to us. On the other hand, we think that many of the residential sectors, apartments, manufactured housing, single family rentals, I think look better, and those are easier stories to get behind. And so in those cases, we think the public market's reaction has been overdone.
And finally, the million-dollar question, what do you think is going to be the lasting impression on real estate from the COVID-19 pandemic?
The crystal ball is cloudy, and we're trying to think about the future. But I think one thing that really stands out to me in particular is the collective pleasant surprise at this forced work from home experiment. And I think that's going to have lasting effects. I think this is an early candidate for if there was an award for most critical real estate issue of this decade, I think this would be it. And that award obviously would go to e-commerce and the impact on retail and industrial in the last decade. I think this similarly could have that type of significant impact on several different sectors in the coming years. I think it'll take a while to play out, but I think it's obviously potentially a negative for office if to the extent society reworks what sort of cultural norms are and employers and employees come together to sort of make some kind of grand bargain on what's acceptable, what's not, where the productivity is. And that could influence how people spend their working lives in terms of how much they're in the office, where they choose to live. So I think while office likely stands to benefit over the short run from unwinding this decades-long densification trend that packed ever more employees ever more tightly, I think office will benefit from that unwinding. But I think over a longer time frame, there could be some negatives from increased work from home. And I think there are spillover effects there, not only on office, but also on residential. Feels like it's potentially a negative for expensive gateway cities with poor fiscal health, and conversely could be quite good for secondary markets with better fiscal health and suburbs.
Michael, thank you so much for joining us.
Thanks for having me, Matt. It was a pleasure speaking with you.
For more from REITweek 2020, be sure to visit Nareit's website, REIT.com.